Hi, Todd Pouliot, Gateway Financial. Feel free to visit us at mygatewaymoney.com. I have not done one of these videos in a while, so I might be a little bit rusty. But as you know, I just like to put out things that are very straight off the cuff. I don't want to go in with a script. I just want to have a good format for what I want to talk about with you and just discuss that. There's some issues on the horizon that may be of interest for people. And right now, what I would like to talk about is what issues should I consider before the Tax Cuts and Jobs Act sunset provision occurs. And I know here we are in September of 2024, and we aren't thinking ahead because we have an election coming up. But, depending on what party does end up with the presidency and the House, we want to make sure that Congress is working on all of our future and doing what's best for all of us as taxpayers, as Americans, and worried about our future with the national debt. And the Tax Cuts and Jobs Act is a big part of your financial plan. As I always state in here, the number one word I like to use is taxes, taxes, taxes. And the reason is because taxes have the most impact on your financial future than anything else that we can do here as far as investments or anything else. Taxes, taxes, taxes. So many clients have enjoyed the lower tax brackets brought to you by the Tax Cuts and Jobs Act. However, the current tax brackets are expected to change at the end of 2025 when the Tax Cuts and Jobs Act sunsets. Are you prepared? That is the number one question. So we have developed a checklist and we want to have meaningful conversations with our clients about steps that we can take now and after the sunset occurs to ensure that we are making the most of your tax planning goals and needs. And that's one of the things at Gateway Financial that I love is not only are we doing your financial planning, the tax preparation, and the tax planning. You need to make sure all of that is put together and they're all communicated well. So the checklist is we're going to talk about budget and cash flow. We're going to talk about changes in the retirement contribution strategies. We're going to look at proactive planning strategies regarding RMDs. And again, the new rules from the IRS are out for the Secure Act 2.0 10-year rule. Very important. I'm not going to touch on that here in this video. That is a completely separate conversation that we're going to have at a different time. Business owner considerations. So Section 199A and QBI deductions, estate planning and gifting strategies, and portfolio allocations may change after the sunset provision. And that's a big one people are forgetting about is how those allocations may be changed because of those provisions. So again, as I always do here, I'm going to come in, I'm going to share my screen, let you see what I'm looking at. And again, here's the checklist that we make for our clients. So do you need to review how your tax rates will change after the provision? Again, they are going to go up. One of the things that are going to be looked at is also the AMT. Have not had to discuss this in a quite a long time about AMT, but AMT is back on the table. Look at your budget and your cash flow. How will it be affected by a higher tax bill? Income minus expenses equals what you get to keep. So again, the higher tax bill is going to be problematic for most people. And again, along with the inflation that we've had over the last 4 years, this is going to be something that we need to consider as another inflationary standard. And do you need to look at retirement account contributions? So since there is going to be some sunsetting, what has changed in your life? Have you had increasing salary? Have you looked at your portfolio from the growth inside of there? Have you considered alternating your retirement plan contributions? Looking at Roth. This has been the number one thing that we've been trying to help people put in Roth now, because we never know what future tax rates are going to be. But today we do. We do know that the future tax rates are going to be higher. That's why those Roth contributions over pre-tax contributions before the sunset really matter. Now, once that sunset happens, we may have to change our conversation again. That's why financial plan is a picture, financial planning is a movie. We don't always have the same story to tell. And then, favoring pre-tax over Roth after sunset is part of the discussion, but trying to figure out what am I going to do this year for tax and down the road for tax. Paying the lowest amount of tax over your lifetime is better than just figuring out annually. So a retirement account, again, look at the RMDs. The RMD situation has changed drastically over the last few years. So consider more aggressive Roth conversations while you're in a lower tax bracket in order to reduce RMDs later on. This has been a really big conversation. I've had several clients take great advantage of this, and really they have set themselves up to be in a much better position. Are you delaying RMDs from traditional IRAs under the 10-year rule? Again, I'm not going to go deep into this conversation, but if you are in this 10-year rule, you need to be up on it now. And I will say, after reading the finalized IRS rules, it's even more confusing now than ever. Make sure you have the right answers for your 10-year window. Any non-qualified assets, such as home, business, rental property, these are big. These may be considered to have done before the sunset. And something I read earlier today that's really impactful, Eric Holland with SEI, when is the right time to do something? And the answer usually is today. And that was a really impactful thing when I read through him and stating that. And it came down to this here when I said, oh, I have a direct correlation of what you're saying. Maybe we make that sale now because the tax rates are lower now. Are you planning to surrender an existing annuity or life insurance policy? Look at the tax liability. How is that going to change? Non-qualified stock options. Baby, this is a good one. If you've got stock options as part of your compensation, get in there, really figure out whether making an election for an 83B, which is to pay the tax liability when the stock is granted, might be beneficial for you. This is a really big player. If you work for those Fortune 500 companies, that's part of the plan. Some of the smaller tech companies have stock options as part of your plan. Really, really good option here to think ahead. What am I going to do today? Because tomorrow may not be the same answers. Page two, incentive stock options. Also, consider selling ISO if you're in a favorable tax bracket. Boy, that makes a lot of sense, doesn't it? Business owners, large business related purchases. These might be done sooner rather than later. You've been receiving 199A or QBI deductions. Be cognizant what is going on there. I strongly recommend you don't just click yes or no. Have a conversation with your financial planner and your tax advisor, all of you at the same table to figure this out. And what about gift tax? This is going to be a big conversation for gift tax exclusions. We are going to see a shift in that estate planning number. And what are we going to do about that? Consider accelerating your gift strategies now. Think about moving them ahead. I'm not saying that's always the right answer because if you have highly appreciated stock, that might not be the right answer because you want to wait till death to get the step up basis. But look at the gift tax issues and how that might be affected there. Non-qualified portfolio allocation. This is the one that I think I'm going to be spending a lot of time on in the coming months talking about capital gains distributions. I think this inside of our portfolios from today up until probably January 2026 is going to cause me the most headaches dealing with your portfolios. The SALT tax deduction might affect the tax. Again, currently it's 10,000 per year. This has not been a major thing, but let's talk about it getting added back for determining AMT. Using equity in your home, HELOCs. Yes, again, I'm not in favor of HELOCs a lot. I prefer a security-backed line of credit. That's why you always hear me talk about taxable accounts. I think taxable, quote unquote, brokerage accounts are better because I like the security-backed line of credit. But let's look at the interest tied to home debt. And is that going to be subject or deductible to limits? So be careful there. I just want to be very cognizant of using home equity line of credit in a market where the housing price seems extremely high. And I know there's a lot of people that don't remember because we have limited memories on '08, '09, and what happened to the housing market. Don't overdo your home equity line of credit. It's not necessary to put your home in that much risk should something happen to the housing market. And look at your charitable giving strategies. Tomorrow is a wonderful day for me. I'm putting on my 18th annual Bump Set Cure Found. We raise money for cystic fibrosis, and we're doing a great job each and every year. But charitable giving strategies matter. So, cystic fibrosis, we're going to make that stand for Cure Found and determine what are you doing for donations. And one of the things that I see a lot of people forget is this thing called bunching. Bunch donations in key years that make sense for bunching and getting those deductions or charitable deductions put together. Donor advised funds. The list can go on and on. If you're charitably inclined, use the rules to your advantage. And I appreciate you all coming back. I know I haven't posted a video in quite some time, but I feel that this video is almost all encompassing as far it affects every part of our lives. On a daily basis, we go and we spend money and we talk about sales tax and we drive on roads that are taxed and we drive in cars that have a license plate that's taxed. But the income tax and the Tax Cuts and Jobs Act will affect us even after you're retired. Because when you're retired, you're going to pay tax on Social Security. You're going to pay tax on the IRA distributions, pulling money out of a 401k, an annuity, and a pension. All those things are going to matter to you and your financial plan. And we are going to have big changes coming up. And it depending on what tax bracket you're in, how big is that change going to be? So again, I hope you hit the like button. I appreciate that you do sometimes when we're posting this on YouTube, the subscribe button. Those are important things to me. And I appreciate that you share these videos with your friends and tell them about Gateway Financial. We appreciate you. We are humbled that you're our clients and visit us at mygatewaymoney.com to learn more. Have a wonderful day and be well.